Hello everybody, today I'm going to explain why Agfa Gevaert is interesting to invest in. Table of contents of my presentation. First I'm going to tell you something about the company. Then I'm going to talk about profit, liquidity, solvency and profitability. Further I'm going to review the stock exchange and to summarize a conclusion. Agfa Gevaert NV is a Belgian multinational corporation that develops, manufactures and distributes analog and digital imaging products and systems, as well as IT solutions. First, the profit. In 2009 we can see a profit of about 40 million euro. The high profit is due to the lower raw material prices, the one-off effect, and because they work more efficient than the previous year. Because of this, the average monthly cost of sales and management were reduced with 50 million euro. In 2010, the profit continues to rise, because they sold a lot more that year. We can conclude that in 2011, there is a loss of 37 million euro. This is due to the weak economy and high raw material prices on top. The same applies for 2012. In 2013 we can establish another profit. This is because the IT and the direct radiography did very well. Next up, the liquidity. I'm going to discuss the current and quick ratio. First, the current ratio. The current ratio is a liquidity ratio that measures a company's ability to pay off its short-term obligations. A good current ratio is more than 1. So Agfa Gevaert NV has a good current ratio of more than 1 in 2008. This continues to be till 2013, so it generally indicates a good short-term financial strength. The quick ratio measures a company's ability to meet its short-term obligations with its most liquid assets. It also has to be more than 1, so we can conclude that the liquid position of Agfa Gevaert is good. Next, the solvency of Agfa Gevaert. I'm going to compare the debt to equity to the equity to assets. First, the debt to equity. The debt to equity ratio is a financial ratio that compares a company's total debt to the total equity. It's always below 1. That implies a more financially stable business. The equity to assets measures the amount of assets that are financed by the owners of their investments. We can see many fluctuates in recent years. In general, high equity ratios are typically favorable for companies. This is usually the case for several reasons. Higher investment levels by shareholders shows to the potential shareholders that the company is worth investing in. So in 2012 we can see that the company has a very good equity to assets. And in 2013 it drops again, but it's still not bad. If we look at the stock exchange, we can see that in 2010 the share price is higher than the other years. This is due to the strong fourth quarter results. In 2011 and 2013 the stock price drops due to the loss they have suffered. Because the profit recovered in 2012 and 2013, we can also conclude a rising share price. The stock price is 2.03 euro. Why should you invest in Agfa Gevaert after a difficult time of economic problems in 2011 and 2012? Well, they were able in 2013 to make a high profit. And this is because the economy is recovering. So this can only be positive for this company. And if we look at the company's ratios, they have never had problems to pay off their debts. And the company has also a good solvency ratio. Thank you for your attention.